Most people think investing is about beating the market. They're wrong. Investing is actually about controlling yourself. Welcome to the summary of Benjamin Graham's The Intelligent Investor. Warren Buffett calls this the best book on investing ever written. Today, we're going to find out why and how you can use these old-school rules to dominate the modern market. Let's start Chapter 1. Investment versus speculation. Graham starts with a wake-up call. If you're buying a stock because it went up yesterday, you're not an investor, you're a gambler. An investment is an operation that, after thorough analysis, promises safety of principal and an adequate return. Anything else is speculation. Story. Imagine buying a house. An investor looks at the rent it can generate. A speculator just hopes someone else will pay more for it next month. Takeaway. Before you buy, ask, if the stock market closed for 5 years tomorrow, would I still be happy owning this? Chapter 2. The Investor and Inflation. Inflation is the silent thief. If your money earns 5% but inflation is 6%, you are actually losing wealth. Lesson. You cannot hide in cash. You must own assets that grow, mainly stocks, to outpace the rising cost of living. Example. $1 in 1950 bought a full meal. Today, it barely buys a candy bar. Your portfolio needs to grow in purchasing power, not just nominal dollars. Chapter 3. A Century of Stock Market History. Don't be fooled by new eras. Graham looks back at decades of data to show that markets always move in cycles. When everyone is euphoric, be careful. When everyone is terrified, look for deals. Takeaway. Don't project today's high returns into the infinite future. Markets revert to the mean. Chapter 4. 5. The Defensive Investor. This is for the person who has a full-time job and doesn't want to spend 40 hours a week looking at charts. Strategy. Use a 50-50 split between high-grade bonds and diversified common stocks. The rule, never have less than and 25% or more than 75% in either. This forces you to rebalance, selling stocks when they are high and buying them when they are low. Chapter 6. 7. The Enterprising Investor. This is for the active investor willing to do the extra homework. The warning. If you want to beat the market, you have to do something different from the crowd. Most people try to do this and fail because they just follow trends. Strategy. Look for unpopular, large companies or bargain issues that the market has unfairly punished. Chapter 8. The Myth of Mr. Market. This is the most famous chapter in the book. Story. Imagine you own a business with a partner named Mr. Market. Every day, he offers to buy your share or sell you his. Some days he's incredibly optimistic and quotes a high price. Other days he's depressed and quotes a low price. Lesson. Mr. Market is there to serve you, not to guide you. His mood swings are your opportunity. Takeaway. Price is what you pay, value is what you get. Don't let a falling stock price tell you your business is failing. Chapter 9. Investing in investment funds. Graham warns against performance chasing. The insight. Most high-fee mutual funds fail to beat the S&P 500 over the long run. Advice. Look for low-cost index funds. Simplicity usually wins. Chapter 10. The Investor and His Advisors. Most financial advisors are salespeople. If an advisor promises to beat the market for a fat fee, walk away. Lesson. Use advisors for tax planning and estate management, but keep your hands on the steering wheel of your investment philosophy. Chapter 11. 12. 13. Security analysis. Graham gets technical here, but the takeaway is simple. Don't trust the surface numbers. Look at a company's debt, its earnings over the last 10 years, not just last year, and its dividend history. Pro tip. If a company's pro forma earnings look too good to be true, they probably are. Chapter 14:15. Stock selection for the defensive investor. Stick to large, prominent, conservatively financed companies with a long history of dividends. For the enterprising investor, look for companies selling for less than their net value, cash on hand minus all debt. Chapter 19. Shareholders and Managements. You are a part owner of the business. Act like it. Lesson. If management is doing a bad job or paying themselves too much while the stock price stays flat, demand change. Chapter 20. Margin of Safety. The central concept. If you only remember one thing from this book, make it this. If you think a stock is worth $100, don't buy it at $95. Buy it at $70. Example. If you build a bridge that can hold 30,000 pounds, but you only let 10,000-pound trucks drive across it, you have a 20,000-pound margin of safety. Why it works? It accounts for your own human error and bad luck. It's the only way to ensure you don't get wiped out. The intelligent investor's mindset. Friends, investing isn't about the IQ of 160. It's about having the discipline to stay the course when everyone else is panicking. By using a margin of safety and ignoring the moods of Mr. Market, you don't just survive, you thrive.